So we'll spend the rest of the time of this section really looking at the presentation of the financial results and some of the disclosures within an Academy Trust set of accounts. So the first area to look at is your statement of financial activities. That covers the income and the expenditure for the financial year. So the presentation of this very much follows the requirements of the charity statement of recommended practice. And therefore you have fund accounting within this primary statement. Typically, within a trust set of accounts, you'll have 3 fund columns, and then coming to the total for the year with the total for the prior year as well. So one of the points I mentioned earlier is your operational result for the year. So it's good to understand what your operational funds of the trust actually are. Your operational funds within the statement will be your unrestricted funds column and then also your restricted general funds column. Separately to that, you have your capital funds, which are ring-fenced within your restricted fixed asset fund. It is just worth noting, however, and within this presentation in the model accounts, that the restricted general fund column includes the trust's pension reserve. So as you'll see here at the bottom of the column of the restricted general fund, that column is actually negative. And this has often been the case. Although schemes more recently have tipped into positive asset positions, the pension reserve here, which represents your share of the deficit of the local government pension scheme, it's a deficit rather than a surplus, and therefore a deficit brings a liability and a fund will be, therefore the pension reserve will be negative. So when we get to the balance sheet, you'll see that the negative here at the bottom of the page on the restricted general fund is actually comprised of a positive restricted general fund balance less a negative pension reserve, reflecting the pension liability. Within the statement of financial activities, the majority of your educational funding will be coming through your restricted general fund, together with any restricted donations. So this is where the funder or the donor have basically said that those donations have to be used on a specific purpose. Capital grants will come through the restricted fixed asset fund together with other capital donations and grants, and they are in additional to your core educational funding. So in terms of your core educational funding that will come through the restricted general fund, really will be your general annual grants, other DFE, ESFA, local authority grants, and really any other ancillary education income is typically included within the educational operations line. And you can see that in the example within the model accounts. So the bulk of income is within the restricted general fund, and also then you have your capital funding within the restricted fixed asset fund. So you can see here the 554,000 that's coming in as capital income, and that is then coming into the restricted fixed asset fund, and typically the spend against that fund will be your depreciation charge. So when you're looking at the model accounts, you can see this. There's a 949,000 charge in the restricted asset fund in the model accounts. That's comprising 3,000 of amortization on intangible fixed assets, and 946,000 is depreciation on tangible fixed assets. So when you look at this offline, you'll be able to see where that 949,000 is coming from in the notes to the accounts. There's also within here a small amount represented as a transfer out of restricted general funds and into restricted fixed asset funds. So if you look around 3/4 of the way down the page, you will see a -10 going out of restricted general and a positive 10,000 going into the restricted fixed asset fund. So this is representing any revenue or operational funding, and it could be from unrestricted funds as well, or the restricted general funds. It's the revenue funding that you're utilising to spend on fixed assets. So basically what the Coketown Academy Trust accounts are saying is that £10,000 has been spent in the year from the general annual grant, for example, on fixed assets in year. And therefore the aim of all of this is that all of your capital assets are held within the restricted fixed asset fund, which then means you can ultimately reconcile your total fixed asset fund balance to your carrying value of fixed assets on the balance sheet. So here the fixed asset fund balance is 10.125 million, and you can reconcile that back to the carrying value of fixed assets in the balance sheet. 10,000 use of restricted general funds, revenue funding on fixed assets actually is very minimal, and typically you'd often see a much bigger transfer in most trusts going from the revenue funds, the operational funds, into your capital restricted fixed asset fund. Just a reminder on any new schools coming in to the trust, and again you can see this in the model accounts, it's in the comparative column. So for Coketown Academy they assumed this happened in the prior year, but you've got the 8.976 million showing within income within the prior year's books. So that's the value of the net assets that were transferred in for the new schools in the prior year. It'll comprise budget surpluses for those schools that are transferred in, if there are budget surpluses, evaluation of land and buildings, and then also potentially the local government pension scheme liability would be coming in here as well if there is a liability. That would be shown as negative income. So the 8.976 million here is a sort of a net asset position that's been transferred in for the new schools. So basically these accounts are saying that in the prior year, to the tune of almost 9 million, that the trust benefited to the degree of the net, to that degree from the net assets that were coming in from the school or schools transferred into the trust. And that's whether they're local authority schools or coming in from another academy trust. There'll be further analysis of that figure within the notes to the account, so you're expected to break down the net asset value that's being transferred in. Looking at this page, what it's also worth doing is reconciling the results on this page, so the statutory accounts, financial result, to your management accounts. So really, as we've said, the management accounts will be on the basis on which you're budgeting your operational income and expenditure, and that's really the underlying operational result for the year. So how do you find that from your statutory account? So this is by looking at your unrestricted funds plus the movement on restricted general funds, so excluding the restricted fixed asset fund. But what you also need to do is to strip out the pension reserve movements from your restricted general funds. And that's the figure that you should then be able to reconcile back to your management accounts figures at year end. So if we just then move to the balance sheet, just to flag a few points here. If you look at the bottom half of the balance sheet on the statement of financial activities, so we had the negative restricted general fund. So we'll have a look at this in the context of the balance sheet. And when you look at the bottom of the balance sheet, this is where you can actually see that the restricted general fund was made up of a restricted income fund of 464,000 less a pension reserve of 1.4 million. So the pension reserve you can see here is exactly equal to the pension liability, and that will always be the case. Further up the page, we also have intangible fixed assets at the very top of the page, together with tangible fixed assets. So totaling 9.969 million. And remembering that the fixed asset fund value, which you can also see at the bottom of the balance sheet, is 10.125 million. So there's a gap there of 156,000. The fund is greater than the carrying value of fixed assets. And the difference between the two is unspent capital funding. So what you're basically saying is that your restricted fixed asset fund equates to the net book value, the carrying value of fixed assets, intangible plus tangible, plus any unspent capital funding And that's often the case at the year end, where you will have received grants, capital grants, but you may have, for example, until the next March to spend those. So really there's an additional amount of funding that's held for a temporary period of time. So if you're then looking at this to work out what does the trust have as working capital, the key figure to look at here is halfway down the page, so is your net current assets. So that's the 898,000 on the balance sheet here. And that comprises the restricted income fund of the 464,000 that you can see at the bottom of the balance sheet, the unrestricted fund of 278,000. Again, you can see that at the bottom of the balance sheet, plus your unspent capital funds of 156,000. All of those three combined come to the 898,000. So you can see your working capital is being boosted a little bit by unspent capital grants at that point. Your operational funds, as we've said, are your restricted income fund and your unrestricted funds. So that really forms the understanding of where you are as a trust at year end in terms of the movement of the figures year on year, that net current assets figure, understanding why that's fluctuating year on year. If you're seeing a significant decrease in that level of net current assets, that's when you should be really understanding where you're going as a trust and financial sustainability. In addition to that figure on the balance sheet, you have your long-term pension liability as shown in the Coketown model accounts and the fixed assets, which are not deemed to be liquid. So really that net current asset figure is the key figure to understand. So just on the pension liability itself, as I said, in the model accounts, you've got a negative liability here of about 1.4 million. What we've actually been seeing more recently is because of the movements in interest rates, we're seeing more surpluses on local government pension schemes. So actually what that's meant is when the actuaries have reviewed your trust share of the local government pension scheme, it's resulted in a surplus or an asset rather than a liability. Under accounting standards, you don't necessarily recognise that asset, and there was a lot of discussion in the sector around this, but typically trusts have capped that asset at zero unless it can be demonstrated that the surplus, the asset, can be recovered from the scheme. So within accounts more recently, we've seen a sort of a zero pension reserve, which actually means that understanding the balance sheet and your funds is a little bit more straightforward because you don't have the distorting impact of that negative pension reserve. So what we'll now look at is really the remainder of the accounts in terms of other specific Academy requirements, the presentation of those. In terms of accounting policies, for all material items, you should have a policy. The Coketown accounts really help here. They give you all of the industry standard policies that you can follow and really that the majority of trusts follow. Again, you have to read those, you have to understand those and tailor them to the trust as required. Some of them might not be relevant to you. Also, just to note here, as I mentioned earlier, going concern will be included within this section within the narrative accounting policies and should be consistent with what you're saying within the trustees report. Again, looking at the wording in terms of the requirements of the accounts direction, but really looking at that solvency, the future financial sustainability of the trust. So really making sure that you're looking at solvency, and if solvency is in question, then you'll need to expand on the going concern statement quite significantly, remembering that 12-month period is the absolute minimum that you should be considering. There should also be recognition within the accounting policies of any material areas of judgment, critical estimation that should be brought in here. Again, Coketown does include some examples of those, but again, making sure that you're recognising any judgmental areas of estimation and reflecting those here. So moving down to the notes to the accounts, firstly looking at the income notes to the accounts, some really detailed requirements here within the model accounts and the accounts directions. There is a note within the accounts direction that's not applicable to most trusts around the ability to carry forward funds. But that was a requirement when many of the much older trusts had their original funding agreements set up, and that was a restriction on how much GAG funding could be carried forward unspent year on year. If it is relevant still to your trust, then you do need to disclose that within the accounts. Most trusts don't need that, and the main income note is the note that's been replicated here, which is the funding for educational purposes. If you have boarding activities, teaching school hubs, then you also need to give relevant information here as well within the income note. Just in terms of the ESFA's emphasis on this, more recently lots of emphasis within the accounts direction. Trusts were previously aggregating together many of the other DFE and ESFA grants. There is now a requirement to set out the material grants and specific grants within that section. So do look at the model accounts here to make sure that you're listing those that are relevant individually within this note. So just moving down the expenditure note, pretty stable year on year in terms of expenditure disclosures for trusts. If you do have a teaching school hub, you should be separating out the costs as well from the core academy activities, and also boarding activity costs as well if it is relevant for your trust. So what we also have within the expenditure note is a requirement to disclose losses, write-offs, compensation payments, gifts, bad debt write-offs, really those transactions that fall within the Academy Trust handbook and potentially need ESFA approval as well. You need to show those in aggregate, and with individual amounts falling over £5,000, then you have to disclose the reasons for making those payments, those write-offs. So it can be quite a lengthy disclosure note within expenditure if you have a number of items to disclose within there. The next main note and also lengthy disclosures is around staff costs and employee benefits. So continuing focus on this note, higher paid employees, key management personnel, employee benefits within here as well. So really making sure that you're familiarising yourself with the requirements before preparing the statutory accounts in order that you're gathering the right level of detail. Particularly important for multi-academy trusts because a lot of this detail may be held at school level, and therefore you're going to be having to aggregate that in terms of the relevant disclosures for the multi-academy trust. So requirements here around the separation of and detail around employee benefits, agency costs, restructuring costs, requirements around severance payments as well, the bandings of higher paid employees, the numbers of people employed within the trust during the year as well. The higher paid bandings, still the threshold there of over £60,000 earnings with £10,000 bandings within the disclosures. I mentioned key management personnel earlier on, so this is where you disclose the aggregate amount of pay that has been made to that group of individuals. So probably the senior management team. Also, if you do remunerate any of your trustees, so if you're a trust that still has staff members, such as the chief exec, who is a trustee, then there should be disclosure here of their remuneration, separate disclosures of pension contributions in bandings as well. So really look at that note carefully and the requirements of it. It could attract some scrutiny as well, obviously from stakeholders of the trust, employees, wider readers of the accounts. Related parties, very much an area that the ESFA continue to be very keen on. Obviously requirements here for certain ESFA approvals for related party transactions, or at least retrospective reporting of those. So really making sure that you are understanding any related parties within the trust that need to be disclosed. What we've often seen is the ESFA will come back to trusts after they've filed accounts, because what they're trying to do is match the approvals that have taken place online with the disclosures within the account. So really be very clear here, confirming that you've met the requirements of the Academy Trust handbook and that you're really hot on the related party disclosures and what needs to go in here. So for example, around the at cost requirements, The disclosures within the model accounts, really useful, a really good guide as to what you need, looking at income and expenditure separately for those as well around related party transactions. So finally, just in terms of other notes to the accounts, many of these are relevant if you're a multi-academy trust and have a number of schools or academies within the trust together with the central office. Number of additional disclosures required here. And there is a section of the accounts direction guidance that looks at the specific disclosure account requirements for multi-academy trusts. So looking at what those are, expenditure by school required to be given, and also revenue reserves by school. Obviously, if you pool your reserves, then there's no requirement to do that. You would have a statement along those lines to say that actually you're pooling reserves and therefore you do not look at those on a school-by-school basis. But if you do have revenue reserves by school, if you have any schools in deficit, then you need to look at what action you're taking as a trust in order to correct those deficit balances. So this is a cumulative negative fund balance, reserve balance at year end, then you would have a further narrative note on this. You'll also have a note to describe your central services. So what are you doing in terms of the cost recharging with the centre, between centre and schools, the top slicing arrangements, for example. How are you managing the finances of the trust between central office and school? And that would also be coming through within the trustees report earlier on. But really giving a clear idea of how the MAT is structured financially, and that how you're sharing the costs across the trust is critical here. For any academy trust, so single academy trust, multi-academy trust, there are various reserves disclosures, so the funds and reserves. A note that is detailed probably requires quite a bit of early focus in the accounts preparation process, because you're going to be looking at allocating expenditure against each of the core funding streams, so the brought forward funds and also the income in the year. So making sure this very much tallies with the totals that you're representing within your statement of financial activities. So really you're looking at how have you spent each of those material funding streams within the year and allocating the costs to the income on that basis. A good example there is pre-pool premium. How much pre-pool premium have you spent in the year, and you're showing the funding coming in and then also the related spend going out. And then really the total fund balances, total reserve balances carried forward in that table must tally then with your statement of financial activities and also your balance sheet. So really tying the whole set of accounts together, and really important that that note is correct. In terms of commitments, disclosures, so really these are figures that don't form part of the primary statements but will be additional disclosures that you have to give. So for example, operating lease commitments, still following the same disclosure requirements under FRS 2 for now. Very common across trusts, but probably not significantly material in most trusts, but nevertheless, giving the total operating lease commitments needs to be included within here, together with any longer term commitment. So might be much more material, for example, PFI schemes, and where there's a significant cost over a significant period of time. So the trust's future minimum payments under those schemes required, so the total future payments disclosed within the notes to the accounts. Came in relatively recently, the treatment of concessionary loans. So if you do as a trust have any concessionary loans, pretty uncommon within the sector, but ultimately the interest you're being charged is below market rates, then you need to be demonstrating there is a benefit to the trust, and that element of benefit should be reflected within the accounts. The accounts direction covers this in much more detail, and there is a little bit more within the charity statement of recommended practice as well, so a link through from the accounts direction into that statement of recommended practice guidance. As I said, probably unlikely to be that common, but just to be aware of if you do have any concessionary loans. So just very finally, just to note the agency disclosure requirements. So this is where the trust does not recognise the income and expenditure, but acts as an agent. So bursary funds are a good example of this, pretty common for Academy trusts. So really all the Academy Trust is doing is dispersing the monies on behalf of someone else, so on behalf of the ESFA, and is just acting really as a conduit. So here there are various disclosure requirements. There'll be a note to the accounts. The ESFA has just emphasised the requirements for that disclosure note, including not just the income and expenditure that is going through the trust as receipts and payments through that agency account, but also the balance that's being held within creditors at year end. So do make sure that you're looking at the agency note requirements and following the model accounts in terms of the full disclosures here. So that was all I wanted to cover in terms of a quick run through of some of the specific requirements for Academy trusts in terms of the reporting framework. Thank you.